For decades, gold and silver existed in the background of the global financial system, quietly holding their place as the ultimate stores of value. They were revered, certainly, but rarely demanded immediate attention in everyday financial discussions. Stocks, bonds, and digital assets dominated headlines, promising growth and wealth. Currencies flowed seamlessly through the hands of consumers and corporations alike, carrying an implicit trust that tomorrow they would hold their value. This system of faith, largely invisible to the casual observer, is what allowed modern economies to function with astonishing efficiency until cracks began to appear. Today, those cracks are no longer subtle. Gold and silver are moving in a way that commands attention. Their recent price surges are not the result of random speculation or fleeting market sentiment. Instead, they reflect a profound shift in the perception of value across the global financial landscape. Investors, institutions, and governments alike are beginning to recognize that the foundations of the current system are less stable than previously assumed. Confidence in paper-based currency is eroding, and with it, the certainty of wealth preservation that citizens and investors have long taken for granted. The reasons for this awakening are deeply intertwined with systemic risk factors. For one, global debt levels have escalated to a point that is mathematically unsustainable without either crippling austerity measures or currency debasement. Governments around the world have relied increasingly on borrowing, not as a temporary tool, but as a permanent solution to funding deficits and driving economic growth. Meanwhile, the accumulation of personal and corporate debt has created a parallel pressure within private sectors. The result is a financial system teetering on the edge, reliant on continued confidence to maintain its fragile equilibrium. Gold and silver act as barometers in this scenario. They respond not merely to immediate economic events, but to the cumulative stress within the system. When prices rise steadily over time, it is not merely a reaction to inflation data or geopolitical tensions. It is a reflection of a deeper, systemic acknowledgement that traditional currencies are vulnerable. Historically, these metals have surged during periods of uncertainty, not because their intrinsic value increases overnight, but because trust in alternative forms of wealth falters. The movement of these metals is a silent but unmistakable signal that intelligent money is repositioning itself to hedge against instability. What makes the current surge unique is the convergence of multiple reinforcing factors. Industrial demand, particularly for silver, is accelerating due to its critical role in renewable energy technologies, electronics, and medical applications. At the same time, gold remains the ultimate safe haven, increasingly favored by central banks and sovereign wealth funds, who quietly accumulate reserves without fanfare but with strategic intent. Their actions serve as a tacit acknowledgement that the traditional financial instruments they once relied upon may not withstand future shocks as reliably as physical assets. Moreover, inflationary pressures, whether accurately reported or experienced through everyday consumption, have created an environment where the purchasing power of fiat money is under constant threat. Gold and silver respond to this by preserving wealth, transcending the arbitrary valuations of paper currency. This dual role, as both a protective measure and an asset capable of appreciating during systemic stress, is what makes them indispensable in the current financial climate. In essence, the awakening of gold and silver is not a fleeting trend. It is the first clear sign of a financial revolution quietly taking shape. Investors and institutions alike are recalibrating their approach to wealth, moving away from reliance on abstract promises and toward tangible, historically proven stores of value. The metals are no longer simply investments. They are insurance, a hedge, and perhaps even a statement about the fragility of the system we all rely upon. Those who recognize this early may find themselves better positioned when the next phase of global economic adjustment unfolds. The modern global economy is, in many ways, a house built on credit. Governments, corporations, and individuals alike have borrowed at unprecedented rates, assuming that economic growth would perpetually support ever-increasing levels of debt. For decades, this assumption seemed to hold. Low interest rates, expanding financial markets, and technological innovation masked the underlying fragility. But as debt levels reached historical highs, cracks began to appear, subtle at first, then increasingly undeniable. Today, these cracks are evident not only in stagnant wages and ballooning government budgets, but also in the behavior of the world's most reliable financial safeguards, gold and silver. When confidence in paper currency begins to erode, these metals respond as they always have, by appreciating in value and attracting attention from both institutional and individual investors. They are a direct reflection of the cumulative risk inherent in a global financial system that is struggling to sustain itself. The magnitude of global debt is staggering. Combined government, corporate, and personal debt exceeds hundreds of trillions of dollars, a number that continues to grow exponentially. Unlike physical assets, debt is a promise, a contract contingent on the future ability to pay. When confidence in that ability falters, the value of debt instruments declines. Currency, too, is affected, as debasement and inflation erode purchasing power. In such an environment, gold and silver offer tangible security, a store of value that is not dependent on the solvency of institutions or the stability of financial markets. Central banks, in particular, are acutely aware of this dynamic. They hold vast reserves of gold, not for speculative gain, but as protection against systemic risks. These reserves are quietly accumulated over years, with every movement reflecting a calculated strategy to hedge against currency devaluation and potential financial instability. In many ways, their behavior serves as a warning signal to the broader market. The instruments we rely upon to preserve wealth are far more fragile than they appear. Industrial demand for silver compounds the effect of these financial dynamics. Silver is essential in numerous technological applications, from solar energy production and electric vehicle manufacturing to medical devices and telecommunications infrastructure. Unlike gold, which primarily serves as a financial hedge, silver is both an investment and a critical industrial commodity. This dual purpose intensifies pressure on supply, as industrial usage consumes significant quantities that are not easily recoverable, creating a structural scarcity over time. Historically, periods of heavy debt accumulation and currency devaluation have coincided with surges in precious metal prices. Investors learn, often the hard way, that paper wealth is vulnerable when systemic stress reaches critical levels. Gold and silver, on the other hand, do not require trust in external institutions. They retain value in almost any economic scenario. As confidence in traditional currency falters, the metals do not simply rise in price. They become increasingly central to the very concept of preserving wealth. Another key factor driving the current movement is the delicate balance of real interest rates. In a scenario where nominal interest rates are low but inflation persists, holding cash or bonds effectively guarantees a loss in purchasing power. Gold and silver, immune to the manipulations of central banks in this regard, emerge as attractive alternatives. They provide both protection against currency debasement and the potential for capital appreciation as market participants recognize their scarcity and intrinsic value. In essence, the global debt crisis has created the ideal conditions for precious metals to flourish. Investors are increasingly viewing gold and silver not merely as alternative assets, but as essential components of any portfolio designed to withstand uncertainty. As debt levels continue to rise and the system's fragility becomes more evident, the value of these metals will likely continue to climb, signaling a broader shift in how wealth is perceived and preserved. The story of gold and silver is not merely about price. It is about understanding the structural weaknesses of the financial system and recognizing where real value resides. This recognition is driving the awakening of a global movement toward tangible, historically proven stores of wealth, a movement that could redefine investment strategies for years to come. Silver has always occupied a unique place in the financial and industrial world. Unlike gold, which has historically been viewed primarily as a store of value or a hedge against economic uncertainty, silver serves a dual purpose. It is both a precious metal with monetary significance and an indispensable industrial commodity. This duality gives silver a distinctive position in today's financial landscape, especially in an era characterized by rapid technological advancement and escalating systemic risk. Industrial demand for silver is rising at a rate that few investors fully appreciate. Its applications span across the most critical sectors of modern technology. Silver is a key component in photovoltaic cells, which power solar panels and drive the global push toward renewable energy. It is crucial in the production of electric vehicles, where silver's conductivity ensures efficiency and reliability in batteries, circuitry, and high-performance electronics. Beyond energy, silver is indispensable in medical devices, telecommunications, and advanced computing infrastructure. Every piece of modern technology that relies on efficiency and precision relies, in some measure, on silver. At the same time, silver is finite. The majority of silver mined today comes as a byproduct of other metals, such as copper, lead, and zinc. This means that production is not easily scalable, regardless of rising demand. Mines take years, sometimes decades, to develop, requiring massive capital investment, regulatory approvals, and suitable ore quality. As a result, supply cannot instantly respond to spikes in demand. This creates a structural imbalance in the market. On one side, industrial usage continues to grow, consuming a substantial portion of annual silver production. On the other, investment demand is surging as traders, institutions, and central banks recognize silver's historical undervaluation relative to gold. The gold-to-silver ratio, a metric often used by market analysts, remains significantly above long-term averages, suggesting that silver has room for explosive growth if this ratio begins to normalize. Silver's dual role also contributes to its unique volatility. Because its market is smaller than gold's, relatively modest changes in demand or supply can lead to dramatic price swings. This volatility is often seen as a risk, but it also represents an opportunity. Investors who understand the dynamics of both industrial consumption and monetary value can capitalize on movements that are often faster and more pronounced than those observed in gold markets. Furthermore, silver's behavior is increasingly intertwined with macroeconomic and geopolitical trends. As countries seek to diversify reserves, hedge against inflation, or secure industrial inputs for national infrastructure, silver becomes a target for accumulation. This convergence of industrial necessity and financial strategy is rare in global commodities. Few assets possess the capacity to respond simultaneously to technological expansion, currency weakness, and investor demand. Silver does. Adding to its strategic importance is the emerging focus on renewable energy and sustainability. Solar power adoption, electric vehicle production, and the global shift toward green technology are expected to accelerate sharply in the coming decade. Each of these sectors requires silver in quantities that far exceed current production capacity if they are to reach projected targets. The scarcity created by this mismatch amplifies silver's potential for price growth. Historically, silver has demonstrated the ability to outpace gold during periods of economic adjustment and crisis. Its relatively small market size, combined with rising industrial and investment demand, creates conditions for rapid price escalation. Unlike gold, which often moves steadily, silver can experience parabolic growth, capturing the attention of both institutional and retail investors. Ultimately, silver is no longer merely the poor man's gold. It is a strategic asset with dual value, industrial necessity, and monetary hedge. Its unique characteristics position it as a central player in the ongoing recalibration of global wealth, bridging the worlds of tangible industrial utility and safe haven investment. While retail investors may react to headlines, the true power in the gold and silver markets lies in the actions of central banks and sovereign wealth funds. These institutions operate quietly, often outside the public eye, yet their accumulation of precious metals sends signals that are impossible to ignore. When central banks move, they do so strategically, often with long-term horizons measured in decades rather than months. Over the past several years, central banks across Asia, the Middle East, and Europe have quietly increased their gold reserves at rates unseen since the post-World War II era. Nations such as China, India, and Russia have been particularly aggressive, steadily accumulating significant quantities of physical gold. The rationale is clear. Gold remains the ultimate safe haven asset, immune to the risks of fiat currency depreciation, geopolitical sanctions, and systemic financial instability. Sovereign wealth funds, too, are increasingly allocating portions of their portfolios to precious metals. While these funds traditionally invest in equities, bonds, and infrastructure, the rising uncertainty in global markets has led to a re-evaluation of risk. Gold and silver provide a hedge that no other asset class can fully replicate. They are not just insurance policies against currency collapse. They are tools for maintaining purchasing power across generations. What makes this movement particularly noteworthy is its consistency and long-term planning. Central banks do not accumulate gold or silver in response to short-term price fluctuations. They do so based on a sophisticated understanding of macroeconomic fundamentals, geopolitical risk, and potential systemic failures. Their purchases are deliberate, measured, and often opaque, ensuring that markets are aware of the underlying shift without creating immediate volatility. The impact of these strategic acquisitions is twofold. First, it creates a steady, institutional-driven demand that supports higher prices over time. Second, It signals to the broader market that precious metals are increasingly viewed as essential components of national and institutional wealth preservation. Unlike speculative retail activity, which can be fleeting and reactionary, institutional accumulation represents a structural driver of market behavior. Silver, while less concentrated in central bank holdings than gold, is also benefiting indirectly from these movements. As the price of gold rises, the historical gold-to-silver ratio suggests that silver is likely to follow, often with greater volatility. Investors who recognize this relationship can anticipate significant opportunities, especially as industrial demand continues to grow. Another critical dimension of central bank activity is the geopolitical implication. Nations with rising reserves of gold are less vulnerable to sanctions or international financial pressures. In a world where economic policy can be weaponized, physical gold and to a lesser extent silver serve as shields against external control. This strategic perspective reinforces the notion that precious metals are not merely financial assets, but instruments of national security and economic sovereignty. The silent movement of these institutional players often precedes broader market recognition. By the time headlines report record gold or silver prices, central banks and sovereign funds have already positioned themselves advantageously. Understanding this dynamic provides insight into the structural strength behind the metals' upward trajectory and underscores why their current rise is more than a temporary spike. In summary, the accumulation of precious metals by central banks and sovereign wealth funds reflects a deeper shift in the global financial landscape. It is a recognition that fiat currencies are not invulnerable, that geopolitical and systemic risks are real, and that tangible assets like gold and silver provide unmatched protection. The combination of institutional strategy, long-term planning, and market influence positions precious metals as central pillars in the preservation of wealth in uncertain times. While demand for gold and silver continues to grow, the supply side is facing increasingly severe constraints. Unlike paper assets or digital currencies, physical metals cannot be produced on demand. Mines take years to develop, require significant investment, and are subject to geological and regulatory limitations. This imbalance between demand and supply is a critical factor driving the current bull market and is likely to intensify in the coming years. Gold production has remained relatively stable over the past decade, with only incremental increases in output. Major gold-producing countries such as China, Australia, Russia, and the United States are seeing declining ore grades in established mines. Extracting gold from lower-quality ore is increasingly expensive and labor-intensive, limiting the ability of miners to significantly ramp up production in response to rising prices. In addition, geopolitical instability, environmental regulations, and labor disputes can cause unexpected disruptions, further restricting supply. Silver faces even greater structural challenges. A large portion of silver is produced as a byproduct of mining other metals, including copper, lead, and zinc. This means that silver production is indirectly tied to the economics of these other metals. When prices of byproduct metals are low, miners may reduce operations, inadvertently reducing silver output as well. This supply inflexibility creates a structural vulnerability. As industrial demand continues to grow, the amount of silver available for investment and consumption becomes increasingly limited. Industrial consumption is a key driver of silver scarcity. The metal is critical in renewable energy technologies, particularly in photovoltaic solar cells. Electric vehicle manufacturing requires substantial amounts of silver for batteries and electronic systems. Telecommunications infrastructure, data centers, and medical equipment all rely on silver for its unparalleled conductivity and durability. Once consumed in these applications, much of the metal is not recoverable, further tightening supply over time. Meanwhile, investment demand is surging. Retail investors, hedge funds, and institutional players are increasingly recognizing silver's undervaluation relative to gold. The gold-to-silver ratio remains historically elevated, signaling that silver could experience significant upside if the ratio begins to normalize. Investors anticipating this trend are buying physical silver coins, bars, and ETFs, exacerbating the pressure on an already constrained market. The combined effect of these supply and demand pressures is compounded by global logistical challenges. Transportation bottlenecks, political instability in key mining regions, and regulatory hurdles can delay the delivery of metals to markets. These factors contribute to volatility, causing sharp price spikes whenever physical availability fails to meet investor or industrial demand. Premiums on physical silver and gold products have risen in recent years, reflecting the growing disconnect between paper contracts and actual metal supply. The scarcity dynamic is further magnified by central banks and sovereign funds increasing their allocations to gold. Their strategic accumulation removes large quantities of metal from the market, creating a tighter supply-demand equilibrium. This institutional demand, combined with growing industrial needs and retail interest, creates a situation in which supply cannot keep pace with demand, setting the stage for significant price appreciation. Historically, periods of constrained supply combined with rising demand have led to dramatic upward movements in both gold and silver. Investors who understand these structural pressures can position themselves strategically to benefit from a market that is likely to experience increased volatility, rapid price growth, and unprecedented levels of investor interest. In conclusion, the scarcity of precious metals is no longer a theoretical concept. It is a tangible reality shaped by production limitations, industrial consumption, strategic accumulation, and logistical constraints. This structural imbalance is a powerful driver of the current bull market, providing both a rationale and a catalyst for continued growth in the value of gold and silver. As we look toward the future, one thing becomes clear. Gold and silver are not merely commodities to be traded. They are essential instruments of wealth preservation and financial strategy. The convergence of rising demand, constrained supply, industrial necessity, and systemic financial risk has positioned these metals as central pillars in the architecture of long-term wealth. The next decade will likely solidify their role, as investors, institutions, and governments increasingly recognize the protective and strategic value that precious metals provide. Gold, with its millennia-long history as a store of value, continues to serve as the ultimate hedge against uncertainty. Its appeal is multifaceted. It offers protection against currency devaluation, provides a stable anchor during periods of extreme market volatility, and functions as a universally recognized asset that transcends borders. As governments continue to print money to finance debt, and as geopolitical tensions remain high, the perception of gold as a safe haven will only strengthen. Its price movements are a reflection not merely of speculation, but of fundamental trust in the stability of tangible wealth. Silver, on the other hand, occupies a dual role that makes it uniquely positioned for growth. Unlike gold, silver is consumed in industrial processes, which means its value is supported not only by financial demand, but also by practical necessity. As renewable energy infrastructure expands, electric vehicle production accelerates, and digital technologies proliferate, silver's industrial importance will continue to rise. This duality, industrial utility coupled with investment demand, sets silver apart, making it a metal capable of both rapid appreciation and strategic wealth protection. The strategic behavior of central banks and sovereign wealth funds will continue to influence market dynamics. By quietly accumulating gold and, in some cases, silver, these institutions signal the recognition of systemic vulnerabilities. Their long-term horizon and institutional knowledge suggest that these purchases are not reactive, but proactive measures to preserve purchasing power, hedge against geopolitical risk, and ensure economic sovereignty. For private investors, understanding these signals can provide a roadmap for positioning portfolios in alignment with macroeconomic realities. Another critical factor shaping the future is technological transformation. As economies modernize and digital infrastructure becomes more pervasive, silver's role as a conductive metal in high-tech applications cannot be overstated. Its scarcity and essential nature make it a strategic resource, and any disruption in supply chains could amplify its market value. Investors who recognize this dynamic have the opportunity to participate in a market shaped by both financial and industrial forces, a rare convergence that few asset classes offer. Moreover, public awareness of financial instability is growing. Individual investors are increasingly seeking assets that protect real wealth rather than paper promises. Gold and silver meet this demand by providing tangible security, liquidity, and historical reliability. In a world where trust in central banks and fiat currencies is fluctuating, these metals represent stability and continuity. The combination of constrained supply, rising industrial demand, strategic institutional accumulation, and global economic uncertainty positions gold and silver as central to the preservation and growth of wealth. Investors who act with foresight and discipline stand to benefit from both appreciation in value and the security these metals provide. Those who ignore these signals risk exposure to the erosion of purchasing power and financial uncertainty. In conclusion, the future of gold and silver is not defined by short-term market trends or speculative behavior. It is determined by enduring structural forces: scarcity, utility, institutional strategy, and systemic financial risk. These metals are not optional, they are essential. They represent a return to tangible value in a world increasingly defined by uncertainty, complexity, and digital abstraction. For anyone seeking to protect and grow wealth over the long term, understanding the dynamics of gold and silver is no longer optional. It is imperative.